Good afternoon, ladies and gentlemen, and I'd like to welcome you all here today, and thank you to the Institute for inviting us to speak to you this afternoon. So just by way of introduction, my name is Emer Kirk and I'm a tax advisor and certified financial planner with Harvest Financial Services. I'm joined today by my colleague and fellow certified financial planner, Andy Dixon. And today we're going to look at advising business owners on securing value from their business, and particularly how pensions interact with other reliefs that are available. So just some housekeeping before we start. We'd invite you to ask any questions during the presentation, and I think the question box is at the bottom of your screen. I just mentioned that if you can, just to include your email there in case we don't get to all of the questions, we will email you directly afterwards, or we'll send a response to the Institute if you want to follow up with them if we don't get time to deal with all the questions at the end of the presentation. So just as part of the Institute's wellness programme, Virtual Health for a Virtual World, they've asked us to take a minute's break during the presentation, so we'll do so just before Andy joins us. So today we're going to talk about helping business owners securing value in their business. And by way of introduction to Harvest, it was established in 1993 and since then has become one of Ireland's leading wealth management firms with over 50 employees. We specialise in advising senior executives and business owners on their retirement planning. And a big part of this for business owners is working with them to plan the transfer of value in their business into their personal wealth as tax efficiently as possible. And doing so, we work very closely with their professional advisors, so their accountants, their tax advisors and their solicitors. And we mainly feed into the pension and investment angles of this planning. So today I'm going to look at where pensions interact with some of the more common reliefs used to extract cash from a business tax efficiently, and how secure these assets are in the event of a business failure. Andy's then going to look at investing for growth and maximising funding for pension contributions. The main areas I'm going to touch on today are termination payments and how pensions interact with calculating the tax-free element of an ex gratia payment and any planning that could be done around that. And then I'll look at retirement relief, and many of the conversations that we have with clients have been about holding back on pension contributions to avail of retirement relief. So what I hope to show is how they compare in terms of tax relief for extracting cash from the business, but also how they complement each other as part of a longer term retirement plan. So when somebody's employment is terminated, they're entitled to a statutory redundancy payment, which is calculated as 2 weeks of pay, capped at €600 per week for each reckonable service they had, and an additional one week's pay on top of that. This amount is always tax-free. So then there's three ways to calculate the tax-free element of the ex gratia payment, which is in addition to this. And for two of them, the pension lump sum needs to be factored in. So under current legislation, the exempt amount under any of the three reliefs is capped at 200,000, and this 200,000 is a lifetime limit. And all previous exempt severance payments need to be factored in and taken into account in determining this 200,000 limit. So the three exemptions are calculated and the highest is selected. The basic tax-free exemption is 10,160 plus 765 for each completed year of service. The basic exemption may be increased by €10,000 less the current actuarial value of any tax-free amount received or receivable from the current pension scheme in certain circumstances. And this is where the pensions start to interact with that ex gratia payment. And the main calculation that's of interest to many clients with long service and high salaries particularly is the standard capital superannuation benefit, the SCSB exemption. And it's calculated by taking the 12-month average of remuneration over the last 36 months. That's multiplied by the number of completed years service divided by 15 and less the present value of the tax-free lump sum received or receivable under the pension lump sum. And the future value of the pension lump sum from the pension is calculated as either 25% of the value of the fund if it's a defined contribution scheme, or under the traditional lump sum calculation if it's a defined benefit scheme, or it can be a defined contribution scheme. It's 3/80 for every year of service that the individual has had. And it's important to note that it's the occupational pension scheme related to that employment only. So the pension benefits from previous employments are not included in this calculation. And similarly, where pension benefits are held in a personal retirement savings account, a PRSA, it's not considered to be an occupational pension scheme. So these benefits can be excluded. So the lifetime limit for the tax-free ex gratia payment from the termination payment is 200,000. And the maximum lifetime limit for tax-free lump sum from the pension scheme is also 200,000. So we then ask, are there circumstances where you can get both? And this can happen where an individual has high salary and long service with the company. So just looking at an example, for an individual who has 20 years service at the date of termination, their average annual earnings in the last 3 years is 400,000. The value of the tax-free pension lump sum is 200,000. And it's important that it's the tax-free pension lump sum. So in all cases, regardless of the value of the pension at that point, if it's worth 2 million, an individual might be entitled to take 500,000 as a lump sum from the pension, but only the first 200,000 of that's tax-free. So there is a cap on the present value of that future lump sum that can be deducted from the SCSB calculation. So in this case, the waiver was not signed by the individual. So they were happy for the 200,000 to be deducted from the SCSB calculation. And in this case, when that's deducted, the result is a tax-free amount up to 333,000. But we have to remember then that that's capped at the 200,000. So it is important to remind ourselves of how the pension lump sum can be taken there. And if you have a deferred pension or a personal pension from a previous employment, it can be beneficial to look at drawing down that pension to use up that 200,000 tax-free element of the lump sum. And then the present value of the lump sum for the purpose of this calculation can be reduced, or it may even be zero. So you always exclude the pension lump sum that's subject to 20% tax. So there's certainly some planning when taking termination payments to try and maximize that tax-free ex gratia payment and the tax-free element of the pension lump sum. And it's important to look beyond the immediate situation to the overall view of an individual's circumstances to see if there are previous benefits that can be factored into and some planning to try and reduce that present value lump sum calculation for the purpose of this calculation. So the next relief we're going to look at is retirement relief and how it compares to and complements pension funding. So with retirement relief, you can take tax-free up to 750,000. And that's 1.5 million, if it's a husband and wife who are both company directors and both satisfy the qualifying criteria. There's obviously marginal relief then for proceeds in excess of this. And once the funds are paid, on retirement relief is granted, the funds are in your personal name once the transaction has happened. Alternatively, with the pension, you can take up to the 200,000 tax-free from the fund at retirement, and then up to 300,000 at 20%. But this would require a fund of 2 million. And outside of the lump sum, the drawdown of the funds then are subject to income tax at your marginal rate in retirement. So in terms of tax efficiency at exit, the retirement relief can be more advantageous. There's also a difference as to when it becomes available. So with retirement relief, it's available from 55. And for the company pension scheme, it can be accessed from age 60 or 50 in certain circumstances. So to access the benefit from age 50, you must sever ties with the company. So that's retirement from the company, but also dispose of any shareholding in the company. And it's important when planning an exit from the pension that these criteria are assessed. So we've come across situations in the past where clients have accessed their pension benefits before age 55, really without thought for the possibility of no longer qualifying, meeting that qualifying criteria for retirement relief. And this might have happened where they needed quick access to cash, or they were approaching that 2 million standard fund threshold and they're triggering retirement of the pension to avoid that future excess fund tax liability. So it's important that these decisions are considered in the overall context of a wealth plan. And it's not just the pension looked at in isolation. Next, I suppose, to realise the value of a business, the business has to be sold. So it's the ideal exit is to sell the business, but it's reliant on both attracting a buyer and your willingness to let it go. So while you might build up a company that's attractive to potential purchasers, it can still be dangerous to rely on it happening, because lots of things need to go right for business to get sold, and the market can change very quickly. So it is an unreliable future event that you can't control, and it may not sell for the amount that you want to as well. Another option then is the company buyback of shares, and to do that, you need to build up the capital on the balance sheet of the company of the business to facilitate it. So with the pension as an alternative, or to complement it, the pension allows you to build up a personal asset that's fully funded and completely separate from the limited company that you own. So the funds are built up in an irrevocable trust off the balance sheet of the company. So by diversifying the exit strategy, it means you're consistently building wealth for the future without having to rely on that future event that may or may not happen. And looking at the company buyback of shares, then the cash reserves are built up in the business, and they're subject to corporation tax and possibly a surcharge. If they're invested, the returns will be subject to income tax, to CGT, and possibly exit tax. Whereas the contributions to the pension are deductible for corporation tax on the way in. There's no income tax or exit tax, CGT on the investment returns. So you can enjoy tax-free growth on the investment over its lifetime. So whether it's equity funds or property or cash, the longer that's invested, the more benefit you get from reinvesting the tax-free returns. And just, I suppose, to reiterate that final point, the retirement relief, it is a point in time transaction. And as I've said, lots of things need to go right for a business to get sold, and markets can change quickly. With the pension benefits, while they can be accumulated at a point in time, and Andy's going to talk about that in an example later, in most cases, they're accumulated over the lifetime of the business. So this really puts you in control of your choices and control of your assets. So you're not risking retirement by relying on an uncontrollable event in the future. And it's certainly not the outcome that anyone wants when the day comes to walk away from their business after all the effort and sacrifice. So I think that it's important that it's not that they both work together, can work together. They both complement each other, and it's important to consider both. And when I've looked at third-party sale and company buyback of shares, it's also useful to look at where business owners are passing their business on to children. The pension can also be a very useful tool. So it's very tax efficient. We know it's a very tax efficient way to take money out of the business. So the business owner might have a child or children working in the business, and there's a succession plan that they'll take it over in 5 or 10 or 15 years. And part of that succession plan should include putting business owners in a position where they can take the value out of the business each year as they approach it. That will provide them with an income independent of that business. And the reality is that not all second generation businesses flourish, and it can provide some relief to the children taking over, but there'll be less pressure to draw an additional salary for the retired owner. And for that retired owner as well, that they have security that if the business does falter, their income is independent and secure. It's also a useful tool for estate planning to maybe look after children who are not involved in the business. When you're passing pension assets on death, the treatment really depends on whether you die pre or post retirement and what structure the pension is in when you die. So for death in service, where you're an active member of the company pension scheme, up to 4 times salary can be paid to dependents as a lump sum tax-free, along with a refund of any employer contributions and AVCs. And the balance then is used to purchase an annuity, or if there's no dependent, it's refunded to the company. For PRSAs and personal retirement savings accounts and personal retirement bonds, where the benefit is preserved, the full value is paid tax-free to the estate. And what I mean by preserved benefit is that the individual has left employment or is no longer in pensionable service with that employment. But then for death and retirement, the treatment depends on who receives the funds. And for a spouse, they step into the individual's shoes and they continue to draw an income from the ARF, which is taxed at their marginal rate. For children over 21, they can pay a special rate of income tax of 30% on the balance of the ARF and no further CAT liability. So we've worked with clients where we've used the pensions to take funds from the company, and the objective is to pass these funds directly on to the child not involved in the business on their demise. And the investment mandate then was to generate 4% or as close to the 4% annual distribution from the investment income to preserve the capital value in the fund. And in some cases then where they've passed the ARF on their demise, they've bypassed a spouse. So they have, in the will, they have left the ARF specifically to the beneficiary, the child, who will pay 30% to withdraw the funds from the pension. And this compares to leaving it to the spouse, who could pay up to 52% to extract the funds from the ARF. Obviously, with any of this planning, you need to ensure that the surviving spouse is well provided for. But it can be a very effective way to pass on assets and distribute cash from an ARF as well, where you have other significant assets in the family. So I mentioned earlier about the security of pension assets, and I suppose what happens, and the unfortunate reality is that not all businesses are successful. So what happens when the pension if your business fails? And company pension schemes, executive pension plans are established under an irrevocable trust, whether they're set up as small self-administered pension schemes with a pensioner trustee, or whether they're set up as executive pension plans with insurance companies or their group schemes. They're all established under trust. And there is, as part of the provisions for revenue approval, they must have a provision in the trust that the funds cannot be commuted, surrendered, or assigned. So once the contributions are made to the pension when the company was solvent, they should be protected. For personal pensions, it's an insurance contract. It's not generally established under trust, but again, there's that provision there that it cannot be commuted, surrendered, or assigned. So that legal status is defined in the legislation. And the same as well for PRSAs, and they have the additional protection of the Pensions Act as well, which confirms that there can be no legal or equitable charge assisted to the PRSA assets. The personal retirement bond and the buyout bond, these funds generally come from a paid-off pension scheme or where somebody has left the employment. So it's outside of a company pension scheme, an executive pension plan. So it has left that trust structure, and it's now in a personal retirement bond or buyout bond, and they generally be insured contracts. And there was a recent case just last January, Lahan versus Wealth Options and Brian O'Neill, and the High Court did bring some clarity about how pensions are dealt with in the event of bankruptcy. So I'm not going to go into it here, but I suppose just the outcome was that in the case the official assignee attempted to access the PRB, the personal retirement bond of the bankrupt, for the benefit of creditors, and the court ruled in favour of the official assignee that if there was a lump sum payment available or the option to procure one within 5 years, those sums and options vest in the official assignee. So this has brought some clarity to the different pre-retirement structures and the security of those structures in the event of a bankruptcy. Post-retirement then, we have the approved retirement fund. And while the legal status we know the legal status is not defined in legislation, and the ARF holder is the beneficial owner. And in fact, original ARFs involved direct tax payment from the owner of the pension scheme. The QFM, the qualifying fund manager, paid the payments gross, and the individuals themselves filed their own tax returns on it. ARFs certainly do have a very uncertain status, and they may not be regarded as pensions, and there is a strong likelihood then that assets would become available to creditors, certainly if they're not established under trust. So what this shows really is the importance of the pension structure in securing how important it can be in securing retirement benefits if an individual is or their business is getting into difficulty, and how the correct structure can protect those assets. So just I'm going to finish up now here, and just before I pass you over to my colleague Andy, I suppose just in summary, financial freedom is the driving goal for most business owners, and it's important after taking on all the risks of setting up the business to make sure that when you walk away from it that you've built up personal wealth independent of the business. And many business owners we see so focused on their business that they don't really take time to look how the business is working for them. And the pension is the single greatest benefit that you can have as a business owner, because it not only allows you to consistently build up to 2 million personal wealth tax efficiently, it can be done from the company. So you really don't have to pay a considerable amount towards it. I've looked here at how pensions interact with termination payments and complement retirement relief. So considering all the interactions, the interaction of all the reliefs available as part of a longer term exit plan really can ensure that the retirement is secured well in advance, and that an individual is left with plenty of options as they approach retirement. And many business owners do believe that their business is their pension, that they can sell their business at some stage in the future. And many aspects of it are just so unpredictable. To find the right buyer, to get the right price, a lot of it is outside of an individual's control. So even if the tax reliefs available still don't excite you, the pension really should still be used as an insurance policy in case that payday doesn't arrive. So we'll take a minute here. I'd like to thank you for your time, and I'll invite Andy to join us to continue the presentation.
Okay, good afternoon, everyone. We'll get going for the second part of the webinar. As well as the security of assets, Emer has obviously talked about the various methods that business owners can use in terms of planning to extract wealth from their companies. So what I'm going to talk about initially is, I guess, considerations that clients should have once they've decided on their method or methods of choice as to what to do with that cash as it accumulates. And then I'm going to finish up with looking at, I guess, some of the planning opportunities if they're looking to use an occupational pension plan as their preferred method of wealth extraction. So the first conversation when we're talking to clients now, and this is in relation to either significant cash balances within self-administered scheme pension bank accounts, or indeed in corporate bank accounts within their companies. The conversation tends to initially focus on investment risk, and that's obviously understandable. Clients are looking for alternatives to deposit accounts that have negative interest rates. So they want to move up the risk scale somewhat, but given that they're moving away from cash, they're concerned about essentially downside risk and the risk of their investment losing value. So it is a logical starting point, and as I said, the conversations do tend to revolve around the investment risk initially. But it's important when we're talking about cash and options for cash in the context of either retirement planning or building up funds within the company that we kind of broaden the conversation around risk to incorporate the other risks that clients should be aware of. So a lot of these business owners who are maybe exploring this during the latter stages of their career, or indeed with an imminent business sale or an imminent retirement, a lot of these owners will get the cash out of the company into a pension plan, say, for example, and then look to take their benefits immediately and move from that pre-retirement structure into the approved retirement fund, which is the post-retirement structure. So we need to talk to these clients about sequencing risk, because they're pretty quickly going to be moving from an accumulating structure to a decumulating pension structure. And sequencing risk is the risk of them experiencing an initial poor sequence of returns in those first, say, 2 or 3 years after they make that move. And if you're making withdrawals from a fund, then obviously every time that fund falls, if it does fall, you're going to crystallize those losses. So we need to talk to them about sequencing risk, and we need to talk to them about how we might construct a portfolio that will take that into account. Longevity risk is another one that we need to talk about, particularly where the approved retirement fund is not necessarily an estate planning play. So this would apply to the vast majority of clients who will rely on that post-retirement fund as a source of retirement income. And longevity risk is essentially the risk of you outliving your fund. And obviously, if you don't take on any investment risk, you're not going to achieve any investment growth, and that increases the risk of the fund running out when you still might need that retirement income. And then something that's particularly relevant at the moment in the context of negative interest rates and the potential risk of increased inflation in years ahead as economies hopefully recover from COVID is inflation risk. And I think that because that's relevant right now, and because we're talking about potentially moving funds away from cash slightly up the risk scale from an investment perspective, that's probably worth looking at in isolation briefly. So, I mean, if you just look at the CPI numbers, it's clear that inflation itself in its own right obviously has an impact on a client's purchasing power, or the purchasing power of the client's cash, be that in a company or be that in a pension fund. But it's really when you look at the combination of inflation with a negative interest rate environment, such as the one that we find ourselves in at the moment, that this becomes particularly relevant. So if you were to take a 2% inflation rate, which is a fairly standard sort of target inflation rate for a lot of central banks, and look at a negative 1% interest rate over a 10-year time period, which is not a particularly long time period in the context of putting together a business owner's retirement plan, that would equate to a 25% reduction in the purchasing power of that cash. So it does have a pretty significant impact, and it's something that we need to plan for. So as financial planners or retirement planners, we need to plan for that in a couple of ways. And the first thing that we do is when we're building in retirement cash flow illustrations, when we're looking at future income requirements, and that can be tricky for clients to do, but when they start to sort of estimate their required level of retirement income, then we have to incorporate assumed inflation into those illustrations and just demonstrate the impact of inflation on their future purchasing power. I think the other point that we discuss with clients, and this goes back to the previous slide, which was sort of incorporating all the different types of risk, is that just holding cash, or even just having a pension fund and having cash in a pension fund or on the company balance sheet, is not a zero risk strategy. There's always some type of risk. There's risk inherent with simply having a pension structure and having cash in it. And once clients sort of become more comfortable with that, and they don't necessarily view investment risk in isolation, but obviously also look at all the other risks that they should be taking into consideration. That conversation about the move away from cash into some sort of asset that will give you the potential for growth becomes a lot more manageable. So regardless of what you're targeting as a client in terms of your preferred method for wealth extraction, whether that's retirement relief or using an occupational pension plan, this whole conversation about the implications of taking on investment risk having real life impacts other than just simply protecting your fund or your cash from downside risk becomes it is relevant to both scenarios. And I know Emer said that typically speaking, at least a portion of the funds that come from a wealth extraction strategy via retirement relief will often be a transactional thing or a point in time. We still nonetheless see some clients who are targeting that 750k number as their retirement relief, and they might be looking to accumulate that over a number of years on the company balance sheet. And they might be assuming that some of the 750 will come from a company sale, but they might still be planning for it themselves as they continue to trade. And we use this illustration, which my next slide will show, more for retirement planning, but it is relevant for retirement relief as well. And that if you left those funds sitting in a corporate bank account in this scenario, and that negative 0.65 interest rate was applicable as it is to pension funds as well, then the annual contribution required to fund 750k over a 15-year period would be just over 52,000 euro. Whereas if you were to invest those funds in some manner, in some asset that gave the potential for a net investment return of 3% over that 15-year time period, then that required annual fund accumulation or annual contribution drops to just over 39,000. So as I say, that the level of investment growth that you receive, which is linked into the level of investment risk that you're willing to take, does have implications over and above just protecting your fund. So when it comes to funds inside a company, I guess then what options do business owners have? And they really have three options. And the first, I suppose, is to just accept the fact that those negative interest rates are going to apply over that time period and leave the funds sitting in cash. We do see a lot of business owners structure direct investments through the company. So this might be residential property or even constructing a portfolio of direct equities that they select themselves. There is a 25% annual charge on any income from investments within the company. So that might be rental income or dividends from the equities, and a 33% capital gains tax charge at the end when you do sell the property or liquidate the investment portfolio. There is another option which clients should be aware of, and that's to invest in a structure that would benefit from the gross roll-up investment tax treatment. So pretty much any fund launched by the life companies in Ireland since 2001 would benefit from this treatment. And there are also plenty of options on various investment platforms in the Irish market that offer access to gross roll-up funds. And with gross roll-up funds, there is a tax charge on the 8th anniversary, but it is deferred till then. So that compounding effect of investment returns during that eight-year period can make a difference. And then there's a 25% tax on any growth when withdrawals are made or when the policy is encashed. So it can be more tax efficient to invest through one of these gross roll-up portfolios. The other point there to make is that from the advisor's point of view, the life company, if it is with a life company, will calculate and deduct any tax due. So the proceeds of the investment policy are paid net back into the company, and there's no further tax liability at that stage. So obviously, as a retirement planning and a financial planning firm, we tend to deal with a lot of clients who are looking to extract wealth via occupational pension structures. So these funding illustrations are probably more relevant in the context of pension clients for ourselves. But again, because we manufacture our own self-administered funds, we would have quite a significant amount of clients that still have reasonable levels of cash sitting in pension bank accounts, and they're being hit by this negative 0.65% interest rate. So we kind of show the same sort of illustrations to them. And in this scenario, an individual targeting a fund of €1 million over 15 years and leaving it in that pension bank account would need to, or the company would need to contribute €70,000 a year in order to get to that 1 million target fund. Whereas if they were to invest in a portfolio, say targeting a 3% net return over that 15-year time period, which we feel we're able to construct somewhat cautious portfolios that would offer that potential for growth over 15 years, particularly if the company's paying in on a regular basis. So if they're paying in quarterly or even monthly, then you can see the required annual contribution falls to just over €52,000. So this is often a good starting point to clients when they, and we are getting some inquiries at the moment from clients who are looking for alternative options to cash, just to kind of get the focus away from pure investment risk and to show the potential advantages of taking on investment risk and in investing in a portfolio that offers some potential for growth. And the last point I'd make there then, before I move on to some more occupational pension specific slides, is that that same investment conversation initially tends to focus on an alternative option to cash. So it tends to focus in on a particular asset class, say short duration bond funds, or some kind of cash proxy investment as the starting point. The thing is, again, if you have a sufficient investment time horizon and you're paying in on a regular basis, we can still construct well-diversified portfolios that offer access to growth assets such as equities and property that we would still deem to be cautious and be low risk on the ESMA risk scale. But as I say, still offer access to some of these asset classes that will hopefully outperform funds such as short duration bond funds or any kind of fixed income funds. So that's kind of the next step in that conversation. It's sort of educating the clients on how to view investment risk, maybe having a conversation about what that investment experience will be and that they should expect some levels of volatility within their portfolio. And then we start to talk about broader, more diversified portfolios that are out there, that are available, that would still fit within the risk profile of a cautious investor, be that the individual or the company itself. So just looking at occupational pension schemes then in isolation. And I think one significant difference around an occupational pension scheme and a personal pension plan is the ability for the company to make contributions in respect of historical service. So in a personal pension plan or in a PRSA, so that would typically be for a sole trader or an individual in non-pensionable employment, you're restricted to the amount that you can pay into that contribution as a percentage of your net relevant earnings in that particular year. It's an age-related percentage. The maximum net relevant earnings that can be taken into account is €115,000. So that's it. You can pay your maximum percentage every year, each year, regardless of how much you earn in any one individual year. Once you go beyond that 115,000 cap, and you can't make any contributions. You can backdate a PRSA contribution back to the previous year, but beyond that, you can't really backdate any contributions. Whereas in an occupational pension plan, you do have that capacity as a company director. So I've used an example here that wouldn't be too dissimilar from some of the inquiries that we received. I've taken a 55-year-old married company director with 15 years salaried service and no existing private pension benefits in place. The scheme retirement age I've set for 60, which is the minimum retirement age you can have in an occupational pension scheme. But it's probably important to say there that in the context of someone who's looking to exit the company, say this 55-year-old in a short period, say in the next 6 months, the age at which you can access benefits is not necessarily restricted by that scheme retirement age. So if you've sold the company or if you've wound up the company and you're no longer employed, then you can access benefits from after 50. But in this particular scenario, the company would have the capacity, assuming that there are funds in the company to do so, to make a contribution of 2.15 million, which is the maximum tax efficient pension fund that you can have currently in Ireland. So there'd be a 500,000 gross lump sum payable to the individual, 440 net, and that's now personal cash. That's outside of any pension structures. And the balance then transfers across to the post-retirement fund, which is now a personal asset. And that client can start drawing down income from that fund if they need to. So there is significant scope with occupational pension funds in comparison to personal pension plans in terms of the amount you can get out of the company and into a pension, and the amount of time you can do that overnight actually in this scenario. I think it's probably relevant to talk about the corporation tax relief there in that particular example. So there is a difference as to how the corporation tax relief is applied, depending on how a contribution is split between a regular contribution and a single contribution. So normally the revenue will deem the contribution to be a regular contribution if it's paid for at least 3 years. And in that scenario, full relief is available once it's within the revenue limits in each year of payment for each individual annual premium. If there's a single contribution going in as well, and that single contribution is equal to or less than the regular contribution, then full relief is available against the single contribution in the same year as well. But if you have a scenario similar to the last slide where there's a single contribution which is either the entire contribution, or if it exceeds the regular contribution, then under normal circumstances, that relief is spread forward up to 5 years. So I've put an example down here just to talk about how this works, and also how there is a slight difference for clients who are actually winding up the company. So I've used a male company director here. There is a difference on the funding limits for males and females. Single, age 55, with a salary of 80,000. And this particular individual, unlike the previous example, has already accumulated 400,000 in existing pension funds, and the same minimum retirement age on the scheme of 60. So when you run the revenue maximum allowable contribution limits, that individual or that company will have two options as to how they start to fund if they're looking to fund at the maximum allowable levels. So option one is to just structure it as an ongoing annual premium and pay 260k a year. But there is option two, which is more relevant to clients who are looking to get cash out of the company quickly, and that is to pay a reduced ongoing annual premium of 86,000 and a much larger single premium in respect to back service of 867,000. So just in terms of how that the tax relief works in those two scenarios, under normal circumstances, if the company was to continue trading and the client elected to go with option one, then obviously the 260k is paid over years 1, 2, and 3, and the tax relief on each premium is allowable in that company year in question. And if the client went for the second option, which was to try and maximize the wealth extraction, then they'd obviously go for the 86k annual premium. Again, tax relief on that at 12.5% in each individual year. And then the tax relief on the single premium is spread forward over 5 years. So if you're selling the company, then that might be of interest to the potential acquirer. But if there's actually going to be a cessation of trade, then the revenue will actually allow full relief in that company year in question. So you can actually, if circumstances allow, you can actually extract a significant amount of tax, and still the company still gets corporation tax relief in that particular year. So my last slide is just it's just another example of kind of a smaller planning opportunity, but it is something that we come across from time to time, and this is probably more relevant for clients who maybe have maximized retirement relief, and there's a smaller residual amount of cash still in the company, and they're considering options as to how best to get that out. So there's two ways in which you can calculate a scheme member's tax-free cash entitlement. And by scheme member, obviously in this case, I mean the company director themselves. So the newer calculation and the more typical calculation that we'd use at the moment is 25% of the fund as a lump sum. The first 200k of that is tax-free. But the what we would call the more traditional calculation, which was the only calculation around before the 25% rule was introduced, is the old salary and service calculation. And you can still use this in determining an individual's tax-free cash entitlements. So if you use this calculation, then there's a sliding scale as to how much the client's entitled to in terms of tax-free cash. And it's based on salary and service. So if they've 16 years salaried service at the scheme retirement age, then they're entitled to just over 100% of their final salary as a tax-free lump sum. And the top end of the scale is 20 years service. And if you've 20 years service at the retirement age, then you're entitled to 1.5 times your final salary as a tax-free lump sum. But the interesting point here is that the balance, if any, has to be used to purchase an annuity. Okay, and that's obviously not necessarily most clients' preferred option, because annuity rates are driven by long-term bond yields, and they're obviously particularly low at the moment. But the key point here is that there doesn't have to be any balance at all in the fund. So you can have a scenario where under salary and service, as I said, there's some cash left over in the company. You use the salary and service calculation to calculate the client's tax-free cash entitlements. And you can use up all that cash available, put it into a pension plan. And if the client's salary and service, so in the example below, 20-year service, say, with 133k salary, that client is entitled to take out 200k the pension fund as a tax-free lump sum. And if all there is in the fund is 200k, that's fine. There's no need to go off and purchase an annuity with any of that fund. It just all becomes personal cash in the client's own name outside of any pension structures. So that's it for me. In conclusion, I suppose from my part of the presentation is that we obviously, as Emma said, we do work with clients and tax advisors and accountants, and we need at our end to consider the client's intentions as to which of these reliefs they're looking to use in order to extract cash. But the occupational pension plan one can be an important tool in terms of extracting wealth from the company. Whether or not clients are looking at using retirement relief or occupational pension plans to extract cash from the company, it is important to at least consider options for that cash, given the fact that we're in a negative interest rate environment, and holding cash itself still entails some kind of risk. And of course, we're always here to help on the pension and investment planning. So I think we do have a few questions, but if you want to get in touch with us, then just email justask@harvestfinancial.ie. So I might ask Emer to jump back on then, and might have a look at some of the questions that have come through. I think you're still on mute, Emer.
Thanks, Andy. Yeah, there's a couple of questions through here. I'll take the first one anyway. The questions in the SESB example, you show that the employee getting 200,000 tax-free. Can they also take 200,000 tax-free from their pension? And I suppose the answer to that is that it depends. You know, I think I followed on with an example that showed where an individual has high salary and high service, long service, it's possible to do it. Depending as well on what the termination payment is, it's possible to not waive your right to take the lump sum from the pension scheme, and that preserves the lump sum from the pension scheme. So if the termination payment is of a significant value, and the lump sum from the pension scheme isn't deducted from it, that lump sum then will be available. So it really depends on the circumstances, but it certainly is possible to take both if it's planned properly. There's a question here, I think, Andy, for you, if you want to take it. Why is the exit tax not 41% on the gross roll-up investment?
It's 41% if it's an individual investment bond through one of the life companies, but if it's set up as a corporate investment, then the tax is 25%.
Okay.
I think that was an anonymous question, but if that attendee wants to email Just Ask, I can send on some information from one of all the life companies offer corporate investment bonds, so I can send on some information on that if you do want to email Just Ask. Okay.
And then there's another one here. Instead of selling shares in the company to get the 750,000 tax-free, do the proceeds of a member's voluntary liquidation also apply? I suppose I would say that we're not tax advisors, so we certainly work with tax advisors in terms of planning an individual's retirement relief and accessing it. But what I would say is that you know, my understanding anyway is the retirement relief does apply for voluntary liquidations, so that would be the case.
Yeah. I might take the next one, Emer. What would you suggest for two 75-year-olds with their pension in cash bank accounts, so not in negative rates yet? So I'm assuming these are they're probably approved retirement funds, although they could potentially be a PRSA. And I don't have any sort of magic solution in terms of, as I said, any individual funds or individual investments that we would see as not involving some degree of investment risk, and yet having the potential to produce some kind of return over that in cash. So it really depends on the individual's objectives. If this is an estate planning play, depending on aspects such as their health, we might suggest they stay in cash. But if they're prepared to take on some investment risk, then it's very doable to construct a low risk portfolio that, as I said earlier, still offers exposure to assets like equities and various property funds. Once they have that appetite to take on a degree of investment risk, and once it fits in with their retirement planning circumstances. So it's probably a long-winded answer, but we don't see we don't see funds like short duration bond funds necessarily as offering any kind of return at the moment, and that's sort of next up the risk scale from cash. So if clients do want some kind of return, then they're going to need some sort of exposure to portfolios that at least have some degree of an allocation to equities. Although we do share your concerns about equity markets, and there are specific equity funds, without going into too much detail, that we tend to recommend at the moment.
Okay, I'll take this. I think this is the last question in. Can an employee's historical service be taken into account for getting current year tax relief on a lump sum company contribution? So it is one of the big advantages of a company pension scheme, that you can take account, the company can take account of all of the years of service that salaried service that an individual has with the company, and make a contribution, and that's generally referred to as a special contribution, or it could increase the annual contribution. So there can be an opportunity to significantly fund a pension scheme at the point of retirement, or very close to retirement, and taking account of all of the years of service that the individual, salaried service that the individual had. And I suppose that's one of the points that we would say to people when they're looking at pensions, or even at the point of incorporation. We would say that, you know, from a pensions perspective, it's important to draw even a nominal salary from the company every year, and that will count as a year of salaried service, when it comes to calculating the maximum contribution that the company can make. So the company contribution is based on the revenue limits, which is a pension fund that would give you 2/3 of final salary at retirement, and that's a capital sum. And the contribution, the company contributions then are worked back from that. So it really does depend on the salary at the point of making the contribution, and the number of years of service up to then. So I suppose that's a very long-winded way of saying that definitely, you know, you can take account, and most business owners don't provide for themselves for pensions in the early years. They're reinvesting in the business, but there is an opportunity once the business becomes profitable to make up for all of those years of service where they haven't contributed.
I think that's it. Isn't there any further questions? So I hope you found that beneficial. And as I said earlier, if you do have any other questions you'd like to run past us, then feel free to get in touch. So thanks very much.
Thank you.